In the complex, pulsating heart of global finance, where billions of dollars move each second, and data pulses through invisible networks connecting traders, algorithms, and institutions, a silent revolution has been unfolding. One that has redefined how wealth is created, how risk is managed, and how decisions are made. And at the center of this transformation lies artificial intelligence, a technological force capable of turning a modest $100 into $1 million not through luck or manipulation, but through the relentless logic of computation, pattern recognition, and adaptive learning that outpaces every human mind on the trading floor. The modern stock market, once ruled by intuition, emotion, and experience, has now evolved into a battleground dominated by algorithms that see, analyze, and decide in microseconds. And behind this shift is a new breed of AI systems that integrate machine learning, predictive analytics, and deep neural networks to interpret vast oceans of financial information that would take human analysts decades to comprehend. These systems don't sleep, they don't panic, and they don't dream. They observe, compute, and execute, transforming volatility into strategy, chaos into opportunity, and uncertainty into structured probability. The transformation begins with data, petabytes of it, streaming in from every corner of the economy: stock prices, bond yields, social media sentiment, shipping activity, corporate earnings, weather forecasts, geopolitical headlines, and even satellite imagery of factory output or agricultural fields. This data is cleaned, normalized, and ingested by AI, architectures that use deep learning to find patterns far beyond human perception, tiny signals buried inside massive noise, where each signal may represent the probability of a stock moving up or down within the next second, minute, or day. Reinforcement learning models, inspired by the way the human brain learns through feedback, are trained to maximize reward under uncertainty by testing millions of trading strategies simultaneously in simulated environments, learning which actions produce optimal long-term returns and which lead to losses. Over time, these models develop instincts, not emotional instincts, but computational instincts, refined through the constant balancing of exploration and exploitation, exploring new strategies while exploiting the ones already known to yield profit. The result is a form of artificial intuition, a synthetic intelligence capable of reading the market's pulse with an accuracy that borders on precognition. When such systems are connected to automated trading engines, they can deploy capital with surgical precision, placing thousands of micro-trades per second, adjusting exposure dynamically as new data arrives, scaling positions when probability aligns, and cutting them instantly when the odds turn. The small investor, armed with such an AI, no longer plays a guessing game. Instead, they operate within a probabilistic framework that continuously learns, adapts, and improves, transforming even a $100 account into a compound engine of mathematical growth through thousands of statistically favorable trades. This compounding effect, when combined with the speed and scale of modern AI execution, creates exponential growth potential that would be impossible through manual effort alone. Behind this lies the fusion of several technologies: natural language processing that reads financial news and SEC filings to extract sentiment, computer vision models that analyze satellite images to estimate production levels, and time series forecasting models that predict price trajectories based on fractal patterns invisible to human perception. These models operate in harmony, feeding into ensemble learning systems where multiple AI agents vote or collaborate to generate a consensus on the most probable outcome. This consensus is then transformed into a trading signal, passed to an execution algorithm optimized through genetic programming, which simulates evolution itself, mutating, testing, and selecting the best-performing strategies in a continuous feedback loop. Over time, the AI becomes a living system of intelligence, evolving with the market rather than reacting to it. Unlike human traders, it is not distracted by emotion or bias. It cannot be deceived by rumors or seduced by greed. It processes only the numbers, the signals, the truth buried within data. Every tick, every movement, every heartbeat of the market becomes a lesson, a piece of training material for a neural network that never stops learning. The small account grows because the AI compounds knowledge as much as it compounds capital, and each cycle of learning improves accuracy, reduces risk, and increases efficiency. The transformation from $100 to $1,000 is not a miracle. It's mathematics multiplied by intelligence. When executed over thousands of trades, with risk strictly limited and reward optimized through machine precision, compounding takes over as the invisible accelerator, quietly expanding small profits into geometric growth. But what truly separates AI from traditional automation is its ability to adapt. Market conditions are never static. Volatility regimes shift, Correlations break, and unexpected events, from political turmoil to natural disasters, can distort the most carefully crafted strategies. Yet AI systems built with deep reinforcement learning can retrain themselves on new data, adjusting their internal parameters to match the evolving dynamics of reality. They identify emerging patterns before the mainstream notices them, like detecting unusual buying pressure seconds before a breakout, or sensing weakness in a rally before it collapses. This adaptability transforms AI into a dynamic partner rather than a static tool, a living engine of intelligence that evolves faster than the environment it inhabits. Within major hedge funds, these systems already control billions in assets, executing trades without human confirmation, operating within millisecond windows where opportunity flickers and vanishes before a human can even blink. The same logic can be scaled down for individual investors, where AI platforms now analyze portfolios, predict risks, and optimize allocations automatically, making sophisticated wealth management accessible to anyone with an internet connection. What once required a team of analysts, economists, and quants can now be done by an intelligent algorithm running on a cloud server for a few dollars a month. This democratization of intelligence is reshaping the very foundation of finance, giving small investors access to tools once reserved for Wall Street elites. The AI does not care about the size of your account. It cares only about the mathematics of probability. It treats a $100 position with the same analytical rigor it would apply to $100 million, because its only mission is optimization. It sees inefficiencies, captures them, and compounds the gains. It's a self-reinforcing cycle. More data leads to better predictions. Better predictions lead to smarter trades. Smarter trades lead to more profit, and profit leads to more data as the system refines its models further. Over time, this cycle becomes a flywheel of intelligence and capital acceleration. The key lies in scale, discipline, and time. A human trader might hesitate, second-guess, or be swayed by news headlines. But the AI executes with unshakable logic. It doesn't fear losses, it calculates them. It doesn't chase trends, it models them. Each decision is grounded in math, not emotion. This is why AI-driven systems outperform even the most experienced human traders. They eliminate cognitive bias, the very flaw that defines human nature. The path from $100 to $1,000 is paved not with luck, but with billions of data-driven decisions, each one a fraction of a percent better than randomness. Yet when compounded across millions of trades, that small edge becomes overwhelming. The AI's advantage is consistency. It never tires, never doubts, never forgets. It executes with absolute precision, making the invisible visible and the impossible achievable. And as AI models continue to evolve, incorporating quantum computing for faster optimization, generative models for synthetic data creation, and self-supervised learning for adaptive intelligence, their capabilities will transcend current boundaries. The day may soon come when AI not only predicts price movements, but orchestrates entire market ecosystems, balancing liquidity, volatility, and efficiency in real time, creating a market that is no longer a reflection of human behavior, but an extension of artificial cognition. In that future, the line between investor and algorithm will blur completely, and the story of turning $100 into $1,000 will no longer be extraordinary. It will be the norm in a world where intelligence, not instinct, governs wealth.